Let's talk about the single most problematic, idiotic, and exploitative rule in the world of funded trading, the unrealized drawdown rule. If you don't know what this is, or if you don't understand what it is, I guarantee you are walking into a trap. In this video, I'll be breaking down exactly what this rule is, why it's so incredibly dangerous, but most importantly, how you can beat it. If you're watching this video, there's a very good chance that you're already familiar with the world of sim-to-funded trading, but for those of you who maybe need a quick refresher, or maybe you are new and just stumbled across this video, it's this concept that in a simulated environment, paper trading, you can trade, as in your trade's not really hitting the market, but if you do well enough on this paper account, well then you can earn capital, and if you trade well with that capital, you can actually get real payments. Obviously, that sounds pretty awesome. It's a way for you to engage in the market with lower risk and really scale, especially with some of these now, you can get a massive amount of capital. But it's not that simple. It's not just, oh, you have to trade well and then you get the payouts. Not only do you have to trade well, but you have to follow generally a pretty clear list of rules beyond just, hey, make money. If you're curious, on this video, I do have some standalone videos that break down some of the nuances of more of the difficult and complicated rules to understand, but you should know that not all firms are built the same, and there are many firms. Of course, there's general overlapping rules, but some of them do have their own unique rules, so whatever firm you choose to use, if you want to do sim-to-funded trading at all, I beg of you to look at the FAQ, read the rules, and do your best to understand them, just so you're not taken by surprise. So with the understanding that there's little differences here and there as you start comparing firms, most firms, not all, but most firms have an unrealized drawdown rule. Now at first, as you're listening to me, as you're watching this video, you might be thinking,
okay, you're paying for a trading account to trade with someone else's capital. No duh, if your money goes down at a certain point, you're gonna fail.
I get it, that makes complete sense, but that's not exactly the rule. What you're thinking of would almost be referred to as max drawdown, as in you have this point of where your account was at, and if it drops, and it drops too low, you lose the account. That would make sense, and that's most of the time when you're trading within your own money, your own personal funded account, that's how you would think about it. But this isn't max drawdown, this is unrealized drawdown. To best explain this, let's dive into an example with real numbers. Let's say you fund an account, a personal account, with $50,000. You like a trade setup, you swing pretty hard, and let's say in the trade, it goes up to $53,000, but you think it's gonna keep running, so you leave the trade on, but to protect yourself, because you wanna be mindful of your risk, you put your stop at break even. You're basically saying, hey, I wanna see if it keeps going, but if for some reason it reverts and comes back to break even, whatever, you got stopped out, but it didn't cost you anything. This is how you would normally think about it in your own personal funded account, because this is based off your account values at the end of the trade. So your max drawdown was nothing because you actually never locked anything in. You went up to $53,000, unrealized, that $3,000 profit, came down to break even, didn't keep trending, and you said, okay, I'll come back tomorrow. That's how you would think about it with your own funded account. The concept is referred to as max drawdown, and the measurement is the balance of your account at the conclusion of the trade. The concept itself is pretty simple, and if anything, it kind of relates to that metaphor my dad always told me growing up, don't count your chickens until they're hatched. It's kind of in that world because you're not counting the dollars as the trade is live. However, the unrealized drawdown rule isn't quite so simple. In this example, you start with 50,000, you go up to 53, and then your account comes back down to 50 just because that's your break even. The trend didn't keep continuing for whatever reason. When you're using unrealized drawdown, which is the common tactic for most sim-to-funded companies, it's not saying, oh, you were just break even. It's actually counting it off of that high watermark, almost as if you got out at the perfect value. So this isn't a break even trade. This is actually your unrealized drawdown took a $3,000 hit. At this point, you're probably thinking, that's pretty messed up, but it actually gets worse. One of the most popular account sizes in the world of sim-to-funded trading is a $50,000 account, and this unrealized drawdown rule, your actual drawdown rule, is $2,000, which is only 4%. Some of the best traders in the world still have drawdowns in excess of 4%. I'm talking like legends, and they do this professionally. So already the percentage that you get, 2,000 divided by 50,000, 4%, that's already tight. But remember, as you eat into your unrealized drawdown, it gets even more complicated. Let me give you another example. Let's say you just bought a $50,000 SIM funded account and you're well aware of this 2,000 unrealized drawdown rule. This means that you can only, from your peak value, have a drawdown of $2,000. So let's say you're trading well and your account goes up to 52,000 and it starts to come back and you don't want to give back all your gains. So let's say you decide to lock it in at a $1,000 gain. So basically it goes up, comes back halfway, you say I'm cool with that, and you take it. At this point, that doesn't mean that you're allowed to have your account draw down to $49,000, as in the $2,000 buffer you might think you have, because in reality, these accounts are measuring off of that theoretical perfect high. And at one point on paper, not realized, you were up to 52. So that's now the measurement point. As in, if you go down to 50,000, you're going to blow out. So originally, when you thought you had a 4% drawdown, aka 2K, well, now that you locked in at 1, but theoretically it did go higher at some point in the trade, well, that's going to count, which means your account can now only go down to 50,000, aka a $1,000 buffer, aka only a 2% drawdown. So once again, just to drive this point home, this unrealized drawdown rule is so crippling because it's off of that theoretical perfect exit value, while most of the time when you're trading your own account, it's only from the realized value. So if you traded it from 50, even it went up to 52 and back down to 51, you say, awesome, I'm in at 51, and you're basing it off the conclusion of the trade, not that optimal point throughout the trade. So now that you have a better understanding of what the rule is and why it's so mathematically difficult to beat, you might be thinking, why in the world do we have these rules to begin with? Well, there's a good chance if you look at any of the FAQs of any of these SIM-funded companies, the explanation is something along the lines of,
Hey, we're trying to teach you to be a good trader, and good traders have good risk management. So if anything, this is a benefit for you to grow on your own trading journey.
Now, obviously, I don't know what it's going to say verbatim, but most likely it's going to have similar connotations to that. Now, if you ask me, I'm going to call baloney on that explanation. Remember, these drawdowns percentage-wise are already very small. A 50K account and you have a 2K drawdown, that's already 4%. If we're talking about it from the conclusion of the trade, no less at the theoretical perfect point, your unrealized high, we're gonna measure it down from there and start chipping into your 4% drawdown limit. It just makes it very, very difficult. And even though they're gonna say, oh, this is for you to learn to be better at risk management, in reality, this is their business model. The more people who blow out, the more money they make. Remember, as much as they have this marketing idea of, hey, we're partnering with you, we're traders together, no, they want you to blow out because once again, that's how they make money. In fact, I would take this argument one step further and say not only is it just really tight risk management, but it's actively contributing to the development of habits that are not good in trading. If you ask any professional trader, one of the major pieces of advice that they're going to give you is when you have a winner, let it run. As in it goes, whatever, a couple units in your favor, you set the stop to break even, you take all risk at the table, and you see if you caught that beautiful trophy fish. You give it room to run. Think about what this really means. In your own trading account, let's say you get into the overall market, you go long right here, it starts to go up and up and up. You set your stop to break even, taking all risk off the table. It goes. Then it starts to show some weakness, comes down from the peak, and you say, okay, I think the trend's over. I'm going to lock in my money. So you basically go from A to B, even though there was some point in the middle that was slightly higher. If you ask me, that's a good way to trade because you never know how long the trend is going to last, and you want to be in the trend for as long as possible. However, in the world of this unrealized drawdown rule, you're going to get punished for that because as you're riding, as it starts to turn and you get out, well, that buffer is getting eaten up by whatever the difference is between that peak value and where you decided to get out. So if you're attempting to be a trend following trader, these rules actively promote bad trading habits. And I just want you to be aware of it because you might want to approach these SIM-funded accounts differently than your own funded accounts. Now that we're all on the same page of what is the unrealized drawdown rule, why is it problematic, why is it idiotic, and why, in my opinion, is it exploitative, I should let you know that it's not all bad news. Generally, and I'm not speaking for all SIM-funded companies, but this is a common rule across the board, as soon as you trade well enough that the profit in your account is in excess of the buffer, so in the examples I was using, you have a 50K account, there's a 2K buffer, as soon as you get up to 52K, as soon as your account is sitting above that buffer value, the drawdown rule disappears. I think the best way to explain what I mean by that is with another example. Let's say you start with a 50K account and you go up to 51,500. You gained 1.5K. Unfortunately, if it draws down by 2K and you hit 49.5, well, you hit your drawdown rule and the account is lost. However, let's say you trade from 50 to 52, and then the next day you trade from 52, and let's say you have a lights out day and go up to 55. You are above that buffer, which stopped at 52. The very next day, if you had that drawdown from 55 down to 53, the 2K loss, well, you would actually be fine because you're still above the buffer value. So basically, does the unrealized drawdown rule absolutely suck? Well, in my opinion, it very much does. But the good news is if your account is sitting above the buffer value, you really don't have to worry about it. So now that we realized our ultimate goal is to get above the buffer value, because really that's when you're gonna get those sweet payouts, this brings me to the most important part of the video. How can we get over the buffer? After talking to a lot of other traders, using my own accounts as examples, and doing a lot of deep statistical research, I think there's two main ways that increase your chances of beating the buffer. I think you're gonna find this a little bit funny, but the two methods are pretty much the exact opposite of each other. Option number one is a lot of little gainers. So let's just say hypothetically, you are trading and you just go for a lot of $100, $200 gains, because as you get into the trade, you right away put your profit target and you're just going for that. And then what this allows you to do is as that realized profit locks in, since you're trading up to it and you're never really giving a chance for the trade to start to go the other way, that means your realized and your unrealized are pretty much always the same value. So once again, option one is best described as a lot of little trades where you're putting in a profit target, so your realized and your unrealized are pretty much always the same, basically the opposite of trend following. Option number two is where you either take one or a few big swings and you just hope that you can fill out your buffer and get to that buffer value very early on, and basically just hope you get lucky and sidestep any of those quote unquote bad beats. Both are viable options, but I think they require different personalities. In option one, even though your odds of winning on a single trade are way higher because you're going for a smaller profit and right away locking in, you have to take many more trades to fill out the buffer. In option number two, you're obviously swinging for the fences. You're looking for those big returns right away. But if you get lucky, you only have to do it one or a few times and then you've already filled out the buffer. So the odds of the success of a singular trade are lower, but you just don't need as many. From a pure mathematical, statistical standpoint, the odds of success for both of those are roughly the same because one has a lot more trades, but the accuracy is higher. The other one has a lot less trades, but the accuracy is lower. And when you put those all together, they're pretty equivalent, which means that you should just be taking advantage of whatever makes the most sense to you and really whatever fits your personality best. Overall, I need you to remember that sim-to-funded companies are not your friend. You're trying to make money off of them and they're trying to make money off of you. The unrealized drawdown rule is just one example of basically they're trying to make it statistically more difficult for you to be successful, but I want to be clear, it is not impossible. If you truly understand what these rules are and approach beating them in a methodical way, yes, you can be successful, but I find that a lot of retail traders, especially in the sim-to-funded space, don't really understand the traps that they might be falling for, which is exactly why I wanted to make this video. Is it a difficult rule to beat? Yes, but it is not impossible. Obviously, these are my own thoughts and opinions, and I would love to hear from you in a comment below. Do you think you have a better methodology for beating these rules? Because if so, please share it with the entire community. And of course, if you have any follow-up questions and need me to dive into either this subject or other subjects in a bit more detail, I am more than happy to. Like I said, let me know in a comment below. That's what I have for you today. I appreciate all the good vibes. I'll catch you in the next one.
Peace.